Global Opinion, Ben Ritchie of Aberdeen Asset Investments. He's joining us right now on the show. Ben, while we're taking a look at global equity markets and how they've been performing, obviously there are various other factors that could halt this excitement around equities, which one of the key aspects being the geopolitical issues that we are currently facing. Do you feel that at this point it is more prudent to take a slightly more conservative stance on equities, or that wouldn't be a bother and investments into equity will continue on the back of heavy liquidity?
Well, I think it's more likely, I think, that overall that we're going to continue to see a relatively positive approach towards global equities. But I think that really is set against the context of valuation. We've seen quite a lot of positive progress in the last part of 2019. We've seen resolutions to Brexit. We've seen progress in US-China trade talks. We've seen stabilization in a lot of the weaker manufacturing and industrial data that we'd seen throughout 2019, and I think that has buoyed equity markets globally over the start of this year and into the last part of 2019. And I think it's about delivery from companies in terms of earnings that will probably really be, I think, the key driver of equity markets from here, while the news around Libya and Iraq is putting perhaps a little bit of pressure on markets and pushing oil prices up a bit. I think overall that's not going to be the key driver of global equity markets from here over 2020. I think that's really going to come down to those big issues around trade, around the performance of the global economy, and ultimately about corporates and earnings delivery.
Hi, Guy. Hi, Ben. Pardon me. Sorry. Good afternoon to from India. In terms of valuations, you just highlighted in a lot of these markets which have been trading at their life highs, be it the US markets, the valuations are looking on the expensive side. And similar is the case for the Indian equities as well, which have been trading around their all-time high levels. Are you finding any value here at a time when there is a de-link between what the equity markets have been doing and what the growth numbers have been pegged at? The advanced growth number, I think, for this year have been pegged at about 5% now. Is there any value left in Indian equities? And also, what are your key expectations from the upcoming budget on 1st of February?
Well, I think when we look globally, we still see pockets of opportunity, and I think you've got to see that in the context of incredibly low interest rates as we look around the world. I mean, even in those markets where you have positive short-term rates, they're still at low levels historically, and I think that continues to make equities, and particularly equities where you have confidence in the outlook, where you believe that the earnings growth can be delivered, then I still think that makes the equity markets look relatively attractive, certainly to credit. And if I look at the markets where I spend most of my time focusing in Europe, then when you look at the cash yields that are available relative to the yield on government bonds, and the spread is as high as it has been for many decades. And I think in that context, I think that's going to continue to provide a supportive outlook for equities. And if you can find the right kind of companies where you actually see steady deliverable growth, perhaps, or even more exciting than steady, perhaps higher levels of growth that you believe and are confident that can actually be delivered, then current valuations are probably still sustainable, set against that very low interest rate and cost of capital background. So overall, I think when we look at asset classes globally, we still think that equities look relatively attractive compared to credit, and I think whether we're looking to emerging markets or pockets of developed markets, we see opportunities across all of those different areas for us.
So you are looking at opportunities within the equities, and that's for both emerging as well as the developed markets. But what are the current and the recent trends suggesting with regard to fund flows? Is it going more into developed market equities or into emerging market?
Well, we've certainly seen a stabilization in terms of equity flows in developed markets. So if you look to Europe, which had seen some of the most substantial selling over 2018 and 2019, I think we saw something like $150 billion of assets leave European equities over those 2 years. The last part of 2019 and into 2020 has seen some relative stability and even some signs of inflow. So I think where investors are seeing some signs of stability from a political perspective, from an economic perspective, also expectations from an earnings perspective leveling out, then that's, I think, helping to create an environment where people are looking to put money back to work. And I think that's really being driven driven by the liquidity that we're seeing in markets, which remain very significant, and by that cost of capital, which continues to be very low. And if we can find that environment of some certainty and stability, then certainly that is pushing investors towards equities where they can find those relatively attractive cash yields. And I think we're likely to see that across the board, and we've seen that with flows into EM debt. We've perhaps seen that as well with a picking up of appetite for certain areas within EM equities alongside that. So I think given the excess liquidity that we see in global markets, given that very low level of interest rates, I think providing investors feel comfortable with the sort of macro political backdrop, then they're going to continue to look to put money to work in those markets, because at the end of the day, that's where the best returns can be found.